Good afternoon. Peter Klein, ALINE Wealth, Chief Investment Officer, with you this afternoon on August 19th, 2020, with what we're calling our back nine of 2020 strategy. And as many folks in the audience know, the back nine is a golfing metaphor or term, and it talks about, not that I am any good at golf, but it does speak to the back half of the match, the second half, the 10th through the 18th hole, and during that period, the golfer, or the champion golfer, has to have an extra dose of sort of intestinal fortitude and mental focus, because it's getting down to the end of the match. While in investment management, we're not playing a game here. We are certainly mindful of the periods that we are working on with our clients, and to that end, we do see things in a yearly basis. And so we do here at ALINE Wealth, see the back half of 2020 as sort of an important point for our portfolios under our stewardship. So like the golfer who might be up a couple of strokes at the turn, we are confident that our balanced, although increasingly cautious approach will provide our clients with a win in this sort of terrible year of 2020. And moreover, a strong setup for 2021. Moving forward, our take simply is that animal spirits have run amok. Risks for nearly all assets are elevated and leaving very little room for error. In fact, diversification, which is the mainstay of a investment manager's tool in his toolbox, is ineffectual at this point, given the fact that from both credit and equity and increasingly commodities are all elevated. And this probably has a lot to do with the stimulus that we've seen, and to a greater extent also the animal spirits, where people are just casting aside any concerns about risks. That has us concerned. Hence our cash levels are high, and we are minimizing fixed income, for we feel that fixed income is a one-sided trade, whereby rates are likely only to go higher in the future, not lower much from here. So therefore, there's little opportunity, and at these low interest rates, it's really silly to be sort of allocating towards fixed income risk. On occasion, there are some one-off opportunities, and we're constantly searching and scouring, looking for those opportunities that provide our clients with a opportunistic risk and return trade-off. We're increasingly interested in real assets. Our recent conversation, our recent video, our market roadmap on the case for gold. Clearly, that has helped and has worked well. And we feel the macro setup for that continues, and you'll see a little bit of that going forward. And we're also constructive on infrastructure, water utilities, emerging markets, international and developed markets, cybersecurity. Folks are working from home, and therefore they need to update their cybersecurity tools to protect their enterprises and their databases. Healthcare and biopharmaceutical are also areas we see as opportunistic. We like value over growth. We believe growth has run its course for a bit, and we see more opportunity in active management over passive. James MONTIER from GMO, which is a wonderful firm and very well thought of organization, had come out with this. And I think his case is essentially moral hazard with respect to don't fight the Fed. This idea that anyone could just take undue risks in their investments, and then the Fed will bail them out with the Herculean efforts of quantitative easing in the past cycle, and extremely low interest rates and unheard of stimulus in this cycle. That is, to us, a risk, right? Because moral hazard suggests that folks are taking undue risks and are not concerned with it. Markets don't work that way, folks. There are risks, and we have to be mindful of those, especially when you're working with other people's capital. This kind of over-optimistic thinking that talks about how you're overconfident and markets only go up. That's a very one-sided way of thinking, and it's very dangerous in markets as well as in skiing. So we suggest being humble and waiting for the proverbial fat pitch. Markets from equity to fixed income, and even, as I said, commodities are all much higher than they probably should be. And again, they're providing very little downside protection. So on our worry list, we have, and we keep a worry list, and we keep a list of opportunities as well, although our worry list has gotten a bit long these days. Just a couple of concerns that we have. Remember late last year when we were talking so optimistically, excuse me, about the trade deal with China, phase one, and how great it was going to be, and China was going to buy all these goods from us? Off the table, guys. We are in an economic war with China. That has implications that will be reverberating through the economy for years to come. That's going to be serious. So this notion that the trade deal of late last year is going to propel as it did late last year, I don't see that. Valuations are extremely stretched. We are in highest territory versus earnings, versus cash flow, versus sales, as you'll see in a moment. This is, while not a timing tool, it does point towards lower returns going forward over time. Sentiment is through the roof as well. No one seems to care about the fact that we are in a global recession. Consumer spending and changed behaviors. People are going more towards a 1970s like lifestyle where they're staying home longer and they're cooking and they're not going out and they're not traveling, they're not going to conferences. It's a lot of, their hair's growing longer, not doing the barber as often. There's a lot of that going on. In fact, the savings rate has gone up considerably, and that's really strange in the light of the fact that that markets have gone up. Usually you have a wealth effect. Usually when you have markets that have gone up considerably, as they have in the last few months, usually you have decreased consumer savings, more spending. We're seeing the opposite. That's interesting. And of course, the debt levels, both in the Treasury and corporate, as well as in municipalities, and that's going to have an impact going forward. All right, so sentiment. This is the CNN Fear and Greed, or CNBC Fear and Greed Index. As you can see, we're here. That is kind of odd to me, given where we are in the world today. But then again, markets will do that. They will go to extremes every time. And so we need to be mindful of where we are and where we think we should be. We want to be essentially buying here and selling here and keeping the in-between. This is a Fear and Greed, the same index over time. As you could see, every time we've had a sort of a peak, here we are today, you see what happens afterwards, right? Which sort of makes some sense. So let's be mindful of this sentiment. Liquidity has driven this market to the heights that no one would ever thought. Look at the amount of liquidity in the system, the M2 and the balance sheet of the central banks through the roof. That has implications. But liquidity-fueled rallies, folks, are not the same thing as a new technology like in the 90s when cell phones and internet came out and email, or new markets like emerging markets. We don't have that. We don't have that kind of innovation. What we do have is just money sloshing around and having to go somewhere. That strikes to me as being a bit artificial, and that worries me. In fact, Howard Marks, the well-known guru at Oaktree, had said that there's a fair amount of economic fragility out there, and that they were supposed to be they were support payments designed to replace cash that normally would have circulated through the economy. He's talking here about the stimulus programs. So, this is kind of where we're at, and while I think that the efforts of the Fed and the Treasury earlier in the year, in the height of the COVID crisis, was the right thing to do at the time. I think the markets are taking it too far to the height, too far. And I think therein lies the issue at hand. So we have earnings, or we had earnings, and now we have a fairly destructive earnings platform here. As you can see, the earnings on all these indices have been sharply lowered. The S&P 500 is the 18% negative number. So, okay, don't earnings matter anymore? I mean, isn't it kind of like that's the mother's milk of stock returns? And we have reduced earnings. Obviously, the markets jumping as much as they have are suggesting that this is going to turn around going forward. Well, I guess we'll see. But I think it's all about stimulus. I think this whole rally has to do, as I said earlier, about the massive, unprecedented, global, coordinated amount of stimulus coming into the system. It's unprecedented, as you can see here. And so, sure, it was needed, but it has implications. And those implications are what the Fed and the central banks give, they got to take back. And so I am more concerned, because that's what we do. We're concerned about your money and your portfolio. I'm more concerned with the taking back and the implications that's going to have on markets. Valuations are clearly stretched. This is the highest price to sales multiple that we've ever seen, eclipsing the 1999 level. Folks, this is big news, okay? 2.3 times sales is, it's no other way to say it. It's ridiculous. I mean, you can't have multiples that high and have a sustainable market. So let's put our concern hat on and let's watch things carefully, giving these stretched valuations. And not just price to sales. I earmark this one because that's just sales rather than earnings, which have the ability to be, massaged through accounting procedures. But this is just revenues. We're 2.3 times revenue. I mean, come on. That's getting up there. It is up. That's the highest. So that worries me. Here we have tech valuations versus the NASDAQ. So this is so you can see here how much higher the tech is versus the NASDAQ. And part of the rationale, and I'll say the word rationale, is that what we're seeing here in Microsoft is how the earnings of the technology giant Microsoft has gone from, over the last 10 years, from recurring. And yeah, of course, there should be a higher multiple given to recurring revenues and this subscription modeling kind of platform that these companies have done over the last 10 years. The question is it gone too far? Macro and debt levels are another concern. You can see here, these are the bankruptcies through July, the most since 2009. This is just through July. Doesn't that have some impact? I mean, companies are going bankrupt. I mean, the markets are at highs. I mean, it just seems to me to be nonsensible. And so I have a concern about the way this is playing out. And I would urge you to think about it and to discuss it with us. And we'll be happy to do that with you at any time. The concentration risk is also very important in the sense that you could see a lot of companies here. This is the top 50 of the S&P 500. And as you could see, that's almost 56% of the index is the top 50 companies. So that means that 10% of the S&P 500 is 57%, 56% of the index. Yeah, it gets a little concentrated, and that I think is a worrisome point. And here you have the tech companies again, and they're here we're showing how the software companies are treated. This is their sales next 12 months, and you can see how they are so much higher than those other companies. And yeah, of course, because they are growing faster, they should have a higher multiple to those sales. The question again, is it gone too far? Remember, markets will go to the extreme. It's our job to be able to sort of understand when those extremes are at a danger level. okay? And then when they are, we want to pull back, and when they are at a insane, sort of low level where people are just not realizing, the true intrinsic value of companies, that's when we want to be more of a buyer and more of an aggressive buyer. The macro setup, I mentioned this before, 26 trillion in U.S. federal debt, nearly 80 trillion when you add corporate and consumer and municipal debt. And this does not include unfunded pension liabilities from the Social Security system. So, but, clearly unheard of debt levels. How is that going to have an impact? Of course, it has an impact on the currency, and that's part of our case for gold. But it also has an impact on risk. It has an impact on crowding out, the economic term crowding out. It has an impact on our rating, our government bond rating. We did a piece recently that I urge you to listen to called the Bond Vigilantes, and how can that sort of play into this, and perhaps interest rates could have some upward move due to that. All of this is due to the macro setup of having a lot of debt, and that debt has to be repaid. Money supply, as you can see, as I mentioned earlier, has been through the roof. And again, here's our U.S. federal debt. So I want to thank you for your attention today and appreciate the opportunity in serving you here at Align Wealth, where we are always concerned and very respectful of your customization of your portfolio. We're here to help you get through these difficult times. We hope your family is safe and healthy. So we want to make sure we are proactively speaking with our clients to make sure we are setting the tone for the next few months as we move through and guide your portfolio to what we think will be better times ahead. So stay tuned. We're here for you. Thank you very much.